Hi, welcome to the Money Puzzle. I am Brian. That is Chris, and that is Eric, who Chris actually forgot Eric's name a couple of weeks ago.
That was one of the most embarrassing things I've ever done.
I'm just saying, we've only been working together for 3 years now.
We just met, apparently.
Yeah, and it's funny. Chris is up in front of the room, and he goes in, "That's Eric." I totally forgot your last name.
No, I forgot Eric.
Oh, I thought you just forgot his last name.
Just the brain shut down, and I used a lack of coffee as an excuse. It was like, oh
You
my
did,
gosh,
yeah,
it's the
you
most
did.
embarrassing thing.
It was pretty funny. Actually,
I'm just that easily forgettable.
Actually, I didn't know actually didn't know what you were getting ready to talk about, and then I caught on that you forgot his name. So pretty funny. Anyway,
It was bad.
Yeah. So it's interesting that we bring that part up about forgetting names, because today is all about a recession. So it's all over the news, right? I mean,
Right.
every time you turn something on, it's this fear of a recession. So it's always these times in the market which we wish we could forget, and so just like Chris forgetting Eric's name, sometimes when it's a recession or even a bad market, we like to forget those.
I was wondering how you were going to tie that in. That was
Hey,
pretty good, actually.
It's always, well, at least I'm trying. But anyway, so today's all about a recession. So really the first part of this, we're going to define what a recession is, and doing a little research, we found out that there's many definitions of a recession, or sometimes the definition of a recession is sometimes misinterpreted. And then we'll talk about sort of the do's and don'ts during a recession. And we got a few little statistics that are pretty interesting we found as we were doing research for the show. In the 5 minutes we did the research for the show.
That's more research than you all did. You all just grabbed me out of my office and said we were doing a podcast.
We're like, all right, dude, come on, we're ready. He's like, what are we talking about? Like recession. We'll get there.
I'll come up with something.
Yeah. All right. So first of all, just so you guys know, we actually we changed the name of this podcast to The Money Puzzle. We actually have a TV show comes on every Saturday morning at 10:30 on the ABC affiliate here in Louisville.
WHAS.
WHAS. We actually, I think it's channel
11, yeah.
Yeah, channel 11, 908, I think, on Spectrum. But anyway, and now we got a phone going off. But anyway, so just so everybody knows, make sure you watch that. We actually post that on Saturday, I believe. We're trying to get that noise to turn off.
Miss Producer is back here just jumping through hoops, and she can't make this sound
Yeah,
stop.
that's pretty funny. I've never seen her move so fast. Whoop. But anyway, so the show we post the show that airs on Saturday. So just make sure you tune into that, and make sure that when we post it on, I think it's Monday that we post it, just make sure you like it and share it, celebrate it with us. That'd be awesome. So. All right, so just real quick, we looked up the definition of a recession, and what did we find?
Well, it was interesting because we were talking about, let's make sure that we got the definition right. And when we looked it up, and just for reference, we looked it up in Barron's Investment Dictionary.
Yeah.
And it actually gives you a vague answer because it says most economists would define it as.
Right.
So it is subjective, but most economists would define it as 2 consecutive quarters of poor, I believe was the word that it used. Is
Declining.
That right? Declining gross domestic product, or GDP.
Yeah.
And then we actually had an interesting discussion. Does that mean year over year, meaning as compared to the same quarter last year? Or is that compared to the previous quarter? It actually doesn't define it. So,
No, it doesn't. It doesn't clearly define. So what I always interpreted was negative GDP growth, meaning it had to be a negative number, but it just says a decline. So like last quarter, and this is what Chris and I got in a debate before this, because my understanding was it's negative GDP growth, but it depends on how you record it, but if you were at 7% the previous quarter and it's down to 5%, well, that's not negative. You're still growing at 5%. Yeah. But it has to be it's negative from the last quarter.
Right.
And so that's where the interpretations of a recession, I think, are all over the board.
I agree. That was the biggest takeaway, is what really is a recession? Well, it depends on who you talk to.
Yeah.
And I think the big thing, too, about a recession is, to your point, I've always defined it as negative growth in 2 consecutive quarters, not necessarily year over year or anything like that. But it always goes back also as well as you never know you're in a recession until after the quarterly numbers come out.
Yeah,
That's right.
Oh, yeah.
So we just had the first quarter numbers come out, and we did have that negative
Right.
growth number in GDP. I forgot what it was, like negative
1 point,
1.6.
yeah, I think 1.4, 1.6.
1.4 is what I
1.6,
think,
something
yeah.
like that,
Yeah, 1.4, yeah.
I guess I wasn't prepared for this at all.
Yeah, yeah. That's all right, man.
You didn't know what the subject was when we started.
We can't even define what a recession is.
Yeah,
so.
but if we have another negative quarter of,
Yeah.
I'm sorry, a negative number of quarterly GDP growth, well, we're already in the second quarter. We're not going
Right.
to know what that number is until middle of summer.
Right.
So we could potentially already technically be in a recession,
Right.
which is why you're seeing a lot of talking heads on CNBC and all the other, financial news channels talking about it so heavily at this point.
I actually heard an article that was right along that lines yesterday on one of the news channels that said we can't define that we're in a recession until roughly July when the Q2 numbers come out, which you could be completely out of the recession before you find out you're in it, to your point.
Yeah. Yeah, so it's interesting. We came up with some statistics before we get into the do's and don'ts. And I guess the first point I want to make is when you're talking about a recession, there are so many interpretations of a recession that it's a little hard to define exactly what it is. I think that's what is really what we interpreted in our findings. But some interesting statistics. So how many recessions, of course, I'll ask you, because you weren't in there.
I don't know what you're going to ask.
Yeah, I know. But how many recessions do you think has been in the history of the markets? How many recessions has the economy gone through?
So we're going back 100 years plus.
Yeah.
So if I had to guess, I would say probably 20, 25.
Yeah, 48.
48, okay.
And I thought that was, I thought it was a lot more than what, because really, if you think about in the last 15 years, it's not been that many, and we'll talk about that too, but still 48, I was blown away. I probably would have said 20-something, just right along with you. So I was actually blown away as 48.
Agreed.
Yeah, it was kind of crazy.
Yeah, that was a big number. I would have said 20.
Yeah.
But I think it kind of goes back to that point, and maybe I'm kind of stealing your thunder a little bit. Sometimes, because of the way it's defined, you're out of the recession before you know that you're in it. So maybe that's why we don't remember a lot of them, because we didn't really feel it.
Yeah. Yeah, so the last one we had was in 2007, 2008.
Yep.
Right, that was the last real recession. As a matter of fact, in 2020, we should have had a recession, right?
Yeah.
First quarter of 2020, second quarter of 2020, even a third quarter. I have said before that I actually thought we were headed to a depression, which is a whole different set of.
Yeah, that's a different story.
That's a negative GDP growth of 10% for 4 consecutive quarters. I think that's probably where we were headed. But the government stepped in and said, no, we're just going to start funneling cash out, and we prevented that. But we were absolutely headed to recession. That was no question about that. But again, the government stepped in and started doling out a bunch of money, and it prevented that.
Now we're seeing the results of that.
Yeah, we are.
That's a whole other podcast.
Yeah, it is. It is. So the last one we had was 2007, 2008. The one before that, 1999 to 2001,
Right.
Was the other recession. So now, if you think about that, which I thought maybe we had another one in between that, just kind of thinking back and saying, well, we had some negative periods. But the interesting thing is you can have a negative period like we had, say in 2020, right, where the markets fell off by 30, or the S&P was down, 33, 34%?
Yeah, something like that.
But just because the market's negative doesn't mean GDP was negative.
Right.
There's,
I think that, I was just thinking, I think a lot of people confuse recession with what the markets are doing.
Yeah.
And they're related, but
They
recession is a GDP figure, not necessarily what the markets are doing.
It's an economic figure. It has nothing. Well, it has something to do with the stock market,
Yeah.
but there's really no direct correlation.
Correct.
So.
Yeah, exactly. All right, so does anybody know how long the average recession lasts? Now, when I Googled this, it's pretty interesting. You can go back and look at all the different recessions, and it talks about how long it actually lasts.
Uh-huh.
And the early years, so like in the 1800s or whatever, they were lasting 4 or 5 years. But the ones that were more current were quicker. They were a lot shorter in duration. So anyway, the average is 17.5 months, which I thought was pretty interesting. 17 and a half months, you're typically in and out of a recession. So I thought that was very interesting. And I did not check the one 2007, 2008. I didn't go back and check and see the time length on that. But I think it was over a year, best I can remember.
Wasn't it like March of 2009 or something like that?
Well, March was definitely the,
that when it
was
started
the low
turning
point of the
back up?
market.
The market bottom was April, end of March, beginning of April.
Of 09. Yeah.
Yeah, I think it was in March. But anyway, all right. So what are some of the things that we see, common things that we see clients do or other folks do in the investment world when we go into a recession? What are some of the things you guys typically see?
Well, I mean, the first thing that I would think of is what Eric was just pointing out a minute ago. They're reacting with their investments to something that is not correlated to their investments. They start selling out of positions. They start panicking and getting out of the market altogether. All kinds of things that are reactionary instead of being proactive to it. That's the biggest thing that I see people do.
Well, it's funny, so the biggest days in the stock market occur, the biggest up days in the market occur after the biggest down days.
Yep.
What happens so many times, and luckily, knock on wood, at least personally, I haven't really experienced this with too many clients at this point, but people get overly emotional and they see a few down days in a row and they say, oh, I need to react. I need to make a change. I need to do this. I need to do that. Well, then you're going to miss out on the good days because no one can ever call the quote unquote bottom.
Right.
You just can't. If you call the bottom, you're never going to be able to do that effectively
It's
over
just luck
time.
if you do.
It's really luck if you do.
Yeah.
And every now and then
Agreed.
you're going to get someone that becomes really well known for calling it. A few called what happened in 08. They've also been calling for stuff ever since then.
Yep.
I've been hearing there's a recession coming and there's a crash coming for the last decade. And it just hasn't materialized. And, there's always somebody saying that it's going to happen. And, someone's going to be right every now and then. You can't effectively do that with your investments time after time. If you become overly emotional and you move yourself out of the market, you're going to miss a lot of the run back up. And so if you're going to sell at a bottom, well, and if you're sold out, you're not going to enjoy the ride back up because inevitably we will come out of this.
And I mean, this week has been a great example. Wednesday of this week, we had horrible market conditions. I mean, everything was just tanking. And yet on Thursday, we had, I think it was the second best day in the last 30 years or something like that. So to your point, the best day is usually right after that really horrible day. So bailing out is frequently the worst thing that you could do.
Yeah, I think what's interesting is, and we've talked about this in other podcasts, one of the worst things that investors can do is sit around and watch these outlets of where they get this news about the markets all the time because they absolutely scare you to death. And, Eric we did a podcast maybe a year or so ago, and he looked at the correlation of headlines from CNBC, I think it was CNBC, right?
Yeah.
Or was it, okay, I think it was CNBC headlines versus what happened in the market. And even though there were up days in the market, the CNBC headline was still negative. So they're trying to drive just this negative thought process around the markets. Even though the markets are positive, they still have a negative headline. And I think that's so we get a lot of calls, from clients that are just calling and asking questions. Hey, what's going on? I hear this recession thing. Tell me, what are you guys doing? What do you guys think about it? And that's a great thing to call your advisor and say, what is it that you got, what are you thinking? What should we be doing? Because a lot of times we just have to walk you through it and say, there's no reason to bail out of the market. Right. There's no reason to do any kind of panic selling. There's no reason, to do anything. If nothing's changed in your life, there's no reason to do anything. And a lot of times, in almost every case, they'll say, you know what, I feel better about it, I've talked about it, and I'm good. But where did they come up with this perceived notion that the markets are falling apart? It's because they're watching CNBC or, Fox Business or wherever they're getting their information. They're seeing all these horrible headlines. And again, it goes back to people that get on these shows. They don't get on there to paint rosy pictures. They get on there for doom and gloom because that's what sells.
That's what sells, right?
That's what sells. And so if you can just limit your exposure, I think people would just be much better off.
You'll end up with lower blood pressure,
Yeah.
Better health just from not being stressed out.
Yeah.
And I would say one of the other things is when they talk about the markets going down, they're talking about some major indices. They're not talking about your portfolio. They're talking about the S&P 500 or the Dow Jones Industrial or the NASDAQ. Those are the three big ones, and they'll throw in a few other ones from time to time. But just because the market is down, say, 5%, that doesn't mean that your investments are down that much.
Right.
In fact, they probably aren't. If you've got a good financial plan, your investments are going to be based upon where you are at that particular period in your life, and they're going to do exactly what they're supposed to do if it's done correctly.
Yeah, that's where I was going to go to as well. I mean, so I sat down with someone a couple weeks ago. Been a client for a few years now, and fantastic client. They weren't really worried about the market, but we were having that discussion about what's going on, what we thought, prognostications, all of that, right? We went through the whole thing, and then, of course, we get to their portfolio and performance, and we're reviewing everything. Well, we get to the plan, and you go to the planning, all the planning that we've done, nothing has changed in their plan. Right. Absolutely nothing. They don't need to make a single change to their income. They don't need to make a single change to their portfolio allocation. We had them properly balanced, properly allocated before any of this happened, so they weren't fully exposed to the drop because they didn't need that much risk in their portfolio. They are totally fine.
Right.
Everything from a probability of success of their plan doing well, we're still well above 95-100%. We were good. There was no need to be alarmed. They saw that, like, okay, I'm good. Walked out very happy, chatted about other things, and we were all good from there.
Yeah, and I think so. You bring up an interesting point. I think part of the issue is that we're very short-sighted when we look at things that are happening today. Yeah. So we look at how does the market, when it fell off, it was several days ago. We instantly look at our portfolio and say, oh my gosh, the world's coming to an end. Right. But as opposed to looking at the longer time horizon to say, okay, one day out of thousands and thousands of days that I'm going to live and have my portfolio, it's one day.
Right.
And so while one day can make an impact, we shouldn't make a rush to judgment based on that. So you really do need to sit down and get your plan done, right? And nearly all of our clients have some sort of financial plan that we go through every year. Right. And just say, look, the bigger picture is, we had a negative day. And I'll tell you, the worst meetings of the world, we come in and show a client that they have a negative portfolio growth, right?
Yeah.
That's never a great conversation. But when we look at it in the bigger picture to say, yes, I don't know what the market's going to be tomorrow, but I know one thing. Down the road, it's going to be higher than where the last high we just had. I know that's going to happen. I don't know when, but I know it will. And look at your financial plan. It's 95% or 100% successful. So, yes, we're going to have these up and down days, but overall, the likelihood of you running out of money, which is every client concern,
right,
is the probability is near zero. And so I think that's really kind of the biggest point that we can make in all this recession stuff, that this fears and fear-mongering on TV, is just have a good plan in place and look long-term. Yes, it's important to look short-term, right? Because you want to know your advisor's making good decisions in your portfolio, and he's doing the best they can. He or she, sorry. Don't send emails. Send them to Chris. But no, it's just important that your advisor is making changes in your portfolio to kind of fit what's happening right now in the markets. But just don't make any crazy decisions based on one day when you have such a long time horizon, I guess.
And that's not to say that we don't make changes. We do.
Oh, absolutely.
We make tweaks and we make adjustments, and that's why we're here, right? That's what we do. Mm-hmm. But we don't overreact. We're not going through and changing everyone's portfolio just because we had a couple down days. If we believe in the things that we've done, if we believe in the research that we've conducted in putting together our portfolio's well, we're going to stand by them, and we're going to kind of let them work out the kinks, work through the market. I mean, we aren't necessarily totally sitting on the sidelines, but we're also not being overly emotional or overreacting to the short-term headlines that we're seeing in the news.
Well, look, I mean, we just did that, right? I mean, we meet as a team we meet every week, but we specifically meet once a month as an investment committee, and we talk about sort of what's happening in the markets. what does our portfolio look like? What do our holdings look like? How have they performed? We put stuff on watch list. We had a mutual fund. We sort of put it on a watch list for a couple months, and then, let's say a month and a half or so ago, we said, okay, it's time for us to make some modifications. We fear of this recession thing. We're in a rising interest rate environment. So we all did our research and say, what asset classes perform better historically when we are in a recession fear? And so we made steps in case we go into a recession. We made the steps because we know the recession, again, is a lagging indicator, right? So we won't know until after the same. We talked about that. So what can we do today to have our portfolios perform better if, in fact, that's where we actually are? And so we did that. We made some changes. Now, if we get 2-3 months down the road and decide that that's not where we're headed and the economy's picked back up, then we can make those modifications again.
Some more changes.
But something we'll talk about all the time. But again, it's just important that to you guys that that your advisors should be making modifications, right? It's not something that we should sit around and do absolutely nothing. Right. So we should be making changes. But we're not going in saying, oh my gosh, get completely out of the market. That we're never going to have that viewpoint. At least I don't think so.
We're not going all to gold or anything, are we?
No. But we've had those questions.
I've had a few of those questions.
Can we put gold in our portfolio? No, we can't. No, we're not going to do that. And if you want to know why, just call us and we'll explain that you're really not buying gold when you invest in a gold fund. So you're buying into the options contract for gold. So we won't go down that road. But anyway, all right. So any final thoughts on recession? Sort of ideas, that we would give?
The one thought that I would have is kind of go back and revisit what we had just said is if you've got a good financial plan. Now, that does not mean that you've got investments. That means you have a plan. The investments support the plan. Then these types of things are expected. They are planned on. We know they're coming, and you'll be fine if you stick to the plan.
Couldn't have said it better. Fully agree. That's what we do. Yeah, it's right behind me.
I love how Eric's kind of pointing out the planning part.
Yeah,
absolutely.
Yeah,
that's in the name for a reason.
Yeah, it absolutely is, and just to add. So it is something that we do on an ongoing basis. We do review plans every year. It's not something we just do as a snapshot in time because we believe that, your life changes, right? Everybody goes through changes. You go through market changes, you go through life changes, and you got to know how your assets are affected by your changes. And so, but again, that's why we do financial planning. So with that being said, we'll call it a day on recession. Hopefully this is something we can all forget, like Chris has a tendency to do. And he is getting a little older, so maybe we have to kind of watch that.
Wow, I felt those bus wheels.
Yeah.
Ask which one of us is the older one of the two, though.
I didn't forget his name. I forgot my name before, but not his. But at any rate, so just make sure you tune in to this show. We produce it every week. There's a couple of weeks where we've kind of missed. It's just due to scheduling, honestly, because we're all so busy, and it's kind of tough to always gather us together. So sometimes we'll miss, but for the most part, we do.
Between the three of us, we've all got kids in different school districts and spring break.
Yeah, it's been kind of nuts.
It has been a little crazy around here.
And the summer even gets a little bit more tricky because we're gone quite a bit. But anyway, we do try to produce this every week. We have another podcast, formerly known as Burgers and Bourbon. We're not sure what that name is going to wind up. Still struggling to come up with a name. But anyway, we're getting ready to record 2 of those, so we produce those every Friday. And then make sure you tune in every Saturday morning at 10:30 on our ABC affiliate, WHAS, for our TV show. It's called The Money Puzzle. And if you could share that information out to your friends and family, we'd greatly appreciate it. And I guess I'll let Eric sign us off because he's much better at it than we are.
Yeah, thank you.
Oh, my Eric?
Yeah,
I forgot my name. Okay.
Oh, yeah.
I forgot my name.
I am never going to live this down.
No, yeah, thanks for watching. If you're watching on YouTube, make sure you click that red subscribe button. Watch us on there. Share our content with any of your friends or family that you think might benefit from hearing anything that we had to talk about. If you yourself are wondering about whether or not your plan is in place or good enough, and if your probability of success is going to be high enough to be successful in retirement, give us a call and we can go through that entire process with you. We'll walk you through it from A to Z, show you really how easy it is to go through the process and go through whether or not you're properly prepared for the inevitability of a recession, whether we're in one now or we're going to be in one over the next decade. I mean, we can go through and make sure that you're properly prepared. Thanks.
All right, everybody, have a good week.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.